Before you look at another Federal Reserve press conference, I need to show you something. The biggest risk to the United States economy was never the AI bubble. It was never China. And it was never that man in the blue suit with the red tie in the Oval Office. It's something far more boring. Something you've almost certainly never heard about unless you've gone deep down the finance rabbit hole. And today it starts in Tokyo. Because if you've been wondering why mortgage rates refuse to fall, why stocks randomly freak out every few months, and why the Fed can talk about cutting rates, but financial conditions still feel tight, the answer doesn't start in Washington. It starts in Japan, and more specifically in the most boring asset on earth, Japanese government bonds. Because the country best known for attracting American weebs has also been the duct tape quietly holding the global financial system together for the past 30 years. And that duct tape is starting to peel. To understand why Japan matters so much right now, you need to rewind to 1992. Japan's asset bubble burst. Real estate collapsed. Equities collapsed. And Japan entered what became known as the Lost Decades. A 3-decade stretch of near zero growth, no inflation, and no wage expansion. It was like the economy hit pause and nobody could find the remote. So the Bank of Japan did what central banks do when they're out of ideas. They cut rates to zero, then below zero. And when that wasn't enough, they introduced something called yield curve control, which sounds like a Marvel villain, but actually just means we are going to cap long-term bond yields whether the market likes it or not. The Japanese government superglued interest rates to the floor, which created a massive problem for Japanese investors. Imagine you manage $1 billion portfolio, pension fund, insurance company, major bank. Your domestic government bonds are paying you 0%. You have two choices: accept no return or go shopping overseas. Japan chose option 2. And what followed was a multi-decade global shopping spree that turned Japan into the largest foreign holder of US Treasuries, one of the biggest buyers of US mortgage-backed securities, and the world's largest net creditor nation. Japan became the world's ATM. Not because Japan loves America, because the math made sense. Let me show you exactly how this worked. I use a character called Nick every time I break down a complex trade, because Nick makes the abstract concrete. Meet Nick. Nick wants to generate returns. So Nick walks into the Japanese credit market and borrows money in yen at near zero interest rates. He converts those yen into dollars and buys US Treasuries yielding 4%. After hedging costs and fees, he pockets the spread. Clean arbitrage. That is the yen carry trade. Borrow cheap in yen, invest in higher yielding foreign assets, collect the difference. And when your borrowing cost is near zero, you don't just buy treasuries. Nick buys tech stocks, Nick buys real estate, Nick buys into emerging markets. If it has a pulse and yields more than zero, Nick is interested. At its peak, the yen carry trade was estimated by some banks to be in the trillions. The global markets were running on Japanese Wi-Fi. But the entire trade rested on one assumption, one single belief that held everything together: that Japanese yields would stay near zero forever. In 2024, that assumption broke. The Bank of Japan ended its yield curve control policy, and Japan raised interest rates for the first time in 17 years, then raised them again. I've been watching this unwind in real time, and what I'm seeing in the data is not subtle. In the days immediately following that second rate hike, the S&P 500 fell nearly 6%. Japan's Nikkei 225 plummeted over 12% in a single day, its worst drop since 1987. Markets weren't just reacting, they were sending a signal. Because when Japanese yields rise, borrowing in yen gets more expensive, and hedging the currency risk gets more expensive too. Suddenly, the free money trade isn't free anymore. That 4% treasury Nick was looking at doesn't look so good when his borrowing costs just doubled. The math had flipped, and when the math flips, capital flows flip with it. The money that flowed out of Japan for decades was starting to come home. Repatriation. And it's one of the most underreported threats in global markets today, because the cheapest source of global liquidity for the past 30 years is no longer cheap. And that is where it stops being a Japan story and starts being your story. Here's what most people miss, and it starts with the wrong lever. The yields on long-term US Treasuries are not set by Jerome Powell. The Fed controls short-term rates, the overnight rate, but the 10-year, the 20-year, the 30-year, those yields are driven by supply and demand. And right now, everyone is staring at the wrong lever. Ray Dalio, founder of the world's largest hedge fund, has made this point repeatedly. The essence of what he said is this: watch the bond market. It's the backbone of all markets. It sets the interest rate that determines what all asset returns are going to be. And when supply and demand for bonds breaks down, long rates rise, the currency weakens, gold moves up, and central banks get caught in a bind. That's his framework, and it maps exactly onto what we're watching happen right now. The US is running trillion-dollar deficits every single year. Someone has to absorb that debt issuance. For 3 decades, Japan was a key part of that absorption machine. Japan holds over $1 trillion in US Treasuries. If even a fraction of that gets redirected home, back into Japanese bonds that are now actually paying something, the ripple effect is not a small event. It is a recalibration. That's how you get a situation where the Fed cuts the federal funds rate, short-term yields fall, but long-term yields stay elevated. That is a steepening yield curve. While everyone is hyper-analyzing Jerome Powell's press conferences like it's a new GTA 6 trailer, they're watching the wrong end of the yield curve. And when long-term rates stop cooperating, it stops being a bond market story and becomes an everything story. Here's the part I get questions about every single week. Ben, why are mortgage rates still this high if the Fed is cutting? This is your answer. Mortgage rates are anchored to long-term Treasury yields, not the overnight rate. If the 10-year yield doesn't meaningfully fall, mortgage rates don't magically drift back to 3%. When global demand for Treasuries weakens, the long end stays pinned. Mortgage rates stay high. Housing affordability stays strained. Refinancing stays dead. And stock valuations follow the same logic. Analysts discount future cash flows using long-term yields as the baseline. When those yields stay high, the present value of future earnings compresses. Stocks trade at lower multiples. Even when earnings are fine, the price investors are willing to pay for those earnings changes. That's why markets can feel unstable even when the headlines look calm. Remember Nick from earlier? The guy who borrowed in yen and bought US Treasuries? Nick is unwinding the trade right now, and there are a lot of Nicks. There's a reason this doesn't trend on Twitter. Nobody wants to hear, let's discuss the cross-currency carry trade and how Japanese institutions are reallocating capital. That requires patience and more brain cells than doom scrolling allows for. Instead, people want inflation. They want AI. They want whatever Nvidia did last week. So the narrative gets compressed to, if the Fed cuts rates, financial conditions will ease. And that is not necessarily true. That is the lie we're being sold. That one rate cut fixes everything. That liquidity is automatic. That someone, somewhere, will always show up to buy our debt. But what if they don't? What if the largest foreign holder of US Treasuries decides to take a step back? Then you see global liquidity tighten. And liquidity is the oxygen in markets. When it tightens, the cost of money changes everywhere. Your mortgage rate, your 401k, the corporate credit that keeps companies hiring. That's the story nobody is telling you. Not because it's too complex, because it doesn't get clicks. For 30 years, the United States benefited enormously from being on the receiving end of the world's largest carry trade. That trade is unwinding. The math has flipped. The capital flows are reversing. The real threats in markets are never the loud ones. Those are already priced in by the time they reach your feed. The people watching the loud signals are always the last to know.
The real threats are the ones hiding in plain sight.
That's the bin factor.